I just want to take a minute and just kind of recap where we were with our speakers and really zero in on a few things. So there's really two ways to access real estate. One is direct or through a partnership, and as wealth increases and family size increases, you have the ability to go direct, and you don't have to go through a partnership with Jim or Todd or Patrick. You just have a lot of flexibility. And so if you think about the allocation and the decision around real estate, and if real estate can generate returns or cash flow in the 4 to 6% range, and you owned it without any debt, what would that mean to the portfolio? So a lot of really, really wealthy families own a lot of real estate, and correspondingly, they don't have a lot of debt. So a couple things to think about relative to deal structure is that you've got certain levels of risk, and they talk about it. Number one is the manager risk. You really got to know who you're in partnership with. And so doing outside homework away from them, knowing people that have done business with them or know people that have done business with them, it's actually kept me out of some trouble because I've done some investigation and found out that they weren't as stellar as they say they were. So you've got market, liquidity, and then leverage is a big component. All three of those panelists understood the effect of leverage. It's either good or bad. So if you have too much leverage, in the example that I gave, you can get yourself into a whole bunch of trouble. And so by having low levels of leverage, you have staying power during market downturns. And then the document, which we'll actually get into a little bit next week, we're going to have an attorney and another speaker on governance, about deal governance and really what you want the document to look like. And then lastly, where does real estate fit relative to stocks and bonds and cash? So it has a high cash yield, which you don't get really anywhere else. You have equity buildup. It's an inflationary asset. You have leverage, which helps to increase return. It also can help or cause problems if you have too much leverage. It's a hard asset. And then there's some tax advantages around exchanges. Some people will ask, well, if I just own REITs, does that accomplish the same thing? Not really, because it doesn't have the same diversification effect that you can have either buying an individual asset or owning a fractional interest inside of a partnership whereby you're generating cash flow. So those are some things. It's really a discussion to bring about how real estate can be a very, very effective portion of the allocation and why you would want to consider these things. So how about other alternatives? So now we move into hedge funds and private equity, and we'll go through the material, and then we've got an incredible speaker that will come to us right around the top of the hour. So really, what are hedge funds? Why we hear about them, we know what they are, and so really the goal of a hedge fund is, or a lot of people's psyche is, they want to beat the market, they want to outperform the market. So this is called relative performance. So if the market's up 20%, they want to be up 22. If the market is down 34%, which is where it went, they want to be down 30%. Doesn't sound as good, does it? Well, that's exactly what the hedge fund guys do, because they talk about the difference between absolute returns and relative returns. So relative returns are that you're going to keep pace with the market. Absolute returns is we don't care what the market's going to do. We care about making money and never losing money. So we want to have a consistent return. We just never want to lose. So hedge funds operate on a different plane. So a lot of times when we compare them against the market, it's a little bit of an unfair comparison because their mandate is not lose and have some consistency around the allocation. So what are some of their characteristics? They have very, very loose constraints in terms of what they say they're going to do. They're kind of have a mandate to go anywhere. Managers are somewhat aligned. They charge a management fee, plus they charge a portion of the profits, a portion or a percentage of the amount of money they make. So you hear about really big hedge fund managers making hundreds of millions of dollars and oftentimes billions of dollars, And that is directly related to the incentive fee that they get when they make a lot of money. You know, one of the challenges at the other side of that coin is they oftentimes can be incentivized to take a massive amount of risk to generate a big return because their paydays can be so large. So we have diverse strategies. There's many kinds of hedge fund strategies that exist. There's a mix of correlation to traditional asset categories. That's why when you look back at the Yale allocation, Yale allocates a significant portion of their asset allocation to hedge funds because they're like, hey, look, their correlation is low to my other asset categories, so they give me that diversification effect. So when I combine real estate and hedge funds into my allocation, all of a sudden I get very different risk return characteristics, because you may say, well, endowments are large and therefore they're not applicable to the family. That's not true, because endowments have an obligation to supply university budgets with a significant portion of their income. So they have a distribution goal that they have to match every year. So they're just very similar to a family. They have to create consistency and money in the mail just like a family would. So they have all the same issues around. They got to control volatility. They want consistency. But because of their size, they have a little bit more financial muscle in terms of how they can access, you know, different types. Well, hedge funds are very skill-based. You're really going to live and die by the smarts of the manager. They're illiquid, so you send your money somewhere and you really don't know, other than how they report to you, what they're doing. So there is an element of unknown in terms of fraud risk that it's exposed. So in a scenario like Bernie Madoff, there's manager risk. So you really got to know what controls are in place to know who the manager is and then who's watching the manager. It's super important. And a lot of times they operate with leverage. So leverage is a good or a negative thing in and around how to generate increased returns. They're often loosely regulated. We saw this in the debacle of Bernie Madoff, that they just missed the fraud for a lot of years. So they're loose constrained, they're lightly regulated, and you know, so there's here's kind of the summary of really what they look like, that summary. So what about strategies? What do they do, and how do they do it? Well, there's relative value, event-driven, long, short, and tactical trading. So not that I'm trying to make you an expert on all of these, but they're all just different buckets in which hedge fund managers play in, whereby they exploit various things inside of different markets to generate returns. The goal is to have steady returns without losing money. So this chart, which I know is a little tough to see, is over a relatively long period of time. And what you see in the middle line is that's the performance of the hedge fund index. And above and below it is the green line is the world index. And the dark blue line, or the light blue line, is the S&P 500. So even though the light blue line, or the dark blue line, which is the hedge fund, didn't do as well, it was much more steady during this particular period of time, which gives that complementary effect. Now remember, when you're looking at equity allocations, you've got risk in equities, and then you've got 30 to 40% of your assets in safe assets in treasury bonds. So the higher net worth families in the endowment fund said, look, we don't want to own a low return asset vehicle, so how do we accomplish the same level of diversity and risk controls? And so they add in real estate and hedge funds because they have high expected return and low correlation. So going back to the diversification discussion. So how do you implement a hedge fund? Well, there's a couple different ways. One is you can buy a single hedge fund, or several hedge funds, or you can buy a basket of what's called fund of funds. So it's a fund that's mandate is to own a lot of them. So here on this slide, we kind of just show you the pros and cons. One, when you own one, it's direct. More things can go wrong with that. You know, Bernie Madoff was a hedge fund, and so a lot of people had the majority of their wealth just with that guy. So when that went bad, it really changed their lives. Several hedge funds, you get direct exposure, you got more diversification. Fund of funds, you get even more diversification, but you get dilution, and they're a lot more expensive. The cons are the due diligence is difficult. You know, one of the challenges in the hedge fund world, it's hard to find the managers that are really good, and then a lot of times when you find them, it's hard to access them with the amount of money that you have. So a lot of the bigger firms, the JP Morgans, the Morgan Stanleys, have a menu of hedge funds that they offer to their clients. We just want you to be aware of the cost and the structures associated with those, and they typically perform the due diligence on those managers, so they actually do it for you. So they can be a complementary piece because there is lack of correlation to them and for them. The risk is the manager risk. They're illiquid and you can't see what's going on. So there's a little bit of a black box going on. But one of the things that when you sit down with a hedge fund manager and they're trying to explain what they do, they need to be able to do it in a way that you can understand. If they can't, then, and the strategy is too complicated, then that inherently is somewhat of a problem. They typically are expensive in terms, a lot of them charge a 2% management fee plus a percentage of the profit. So they have to make significantly more than the market in order to have a reasonable rate of return because of the underlying fee structure. So that's just the nature of how they're wired. They're hard to pick. And then this is a chart that shows the performance in good markets and bad markets. And what you see here is they just lose less in difficult times. That's what they're designed to do. And then they're designed to capture most of the upside in a good market. So they don't want to have the variability of stocks. They want to be somewhere below with less volatility. So here's an example of an allocation that has 0 hedge funds to 15% hedge funds to 30% hedge funds, and it just kind of shows you what they look like in terms of return. Volatility is the middle column, and then a Sharpe ratio, which is a measure of how much risk you're taking or how much return you're getting for each unit of risk. So you can kind of see that when you mix hedge funds in, they have a way to dampen volatility. And again, the volatility is the one thing that's the killer for the investor when they're taking cash flows out. So, and then the other side of that coin is just disappointing returns. So I don't know if everybody has heard about Warren Buffett's wager, where he wagered this gentleman who was the founder of Prodigy Partners that just buying an index fund would do better than a basket of hedge funds over a 10-year period of time. So here was the environment, the beginning of '08 to the end of 2018, 10 years. And if you think about that, '08 and '09 were very difficult years. So the fact that hedge funds were designed not to lose money in the downturn was really a perfect period. There were 5 hedge funds. The bet was $1 million goes to charity. The loser pays $1 million. Who do you think won? So here's another poll. And so we'll just take a quick moment. Poll is either Buffett or the hedge funds. Index fund or the hedge fund. What do you think? Well, how can you bet against Warren Buffett? You know, it's very difficult. It's almost like a loaded question, but exactly. The S&P averaged 7%, the hedge funds averaged 2%. So this shows you all 5 hedge funds where they at relative to Warren Buffett. But this is the frustrating thing around this particular space. And so it's great as we bring in our next speaker. He's going to talk about the performance issue relative to hedge funds and sort of what that means. The other side of it is the closures. And so what happens for hedge funds is they don't perform and then they close. So it's difficult to find long-term performance on the data set of the amount of hedge funds that were out there. So this next chart that's up there just talks about launches and closures and liquidations. So when a hedge fund gets behind in their performance, and they typically will have these hurdle rates, meaning they have this return that they need to achieve before they get paid, like that's a preferred return. Jim and Todd talked about it. Todd's hurdle rate is 8%, Jim's is 6%. So you got to get the first 6% before Jim really sees his compensation. Todd, because they're doing development, they have a higher expected return. Theirs is 8. So, you know, hedge funds can clearly have an application. We bring it up in terms of the summit because we want you to be exposed to every asset class. I'm not saying I've got the answer. Hedge funds have been a challenging area for me to find the right guys that you can trust, that have the right set of governance and have the right level of transparency that that give you a level of comfort and that can also execute a strategy that can deliver what it is that you need. So